Good morning, good evening, and good afternoon, our great American patriot men and women who are thinking about buying a house. Thank you so much for joining today's episode. We're going to be going over assumptions, and we're not just talking about asses. We're talking about the loans, folks. We're talking about the loans. This is an amazing product that you can use to get someone's past loan if you're able to qualify and if you have the things that are needed that Tom Rosser with Gateway Mortgage is going to go over with us today. So without any further ado, Tom Rosser, thank you so much for being here. Thank you so much for putting up with my tardiness. We're so excited to be here. What are some of the things that you think we should know of about assumptions, loan assumptions?
Okay. First step on loan assumptions for buyers out there. Most likely the listing is going to be marketed as an assumable loan, right? So you'll have that up front. Your first step is to find out who the servicer of that loan is and reach out to the servicer. Start the process. Go ahead. So you start the process with that servicer, and each servicer will be a little bit differently on how they handle it. But essentially it's a loan application with that servicer.
Okay. And correct me if I'm wrong, Tom, but, and if you know the stats, definitely shout them out. But I think 87% of real estate agents never renew their license, according to the National Association of Realtors. So even if a house isn't marketed as an assumable loan, should it be something that the team of agents that I work with and I should ask the listing agent just to verify with the seller?
Yeah, absolutely. I mean, it's a difference. It's a difference between getting, potentially under 3% and getting over 6%, right? So it could double the interest rate, doubles the amount of interest you pay over time. It is absolutely worth asking the listing side, hey, do you know if the seller has an assumable loan?
Okay, and that's if it's not marketed. Just double check. And then, guys, I want to point out too, everyone on this channel, give Tom a thumbs up. If someone assumes a loan, that doesn't help him out any. Guys, he's literally doing this out of the kindness of his heart because he makes money when he helps you get a loan. Him telling us about assumptions, he's doing it out of the kindness of his heart. So give it a big thumbs up if you guys find this information helpful.
Yes, thank you, Josh. I mean, our plan is to help people build wealth through homeownership, and ideally that goes through us. But if we're going to help people build wealth through homeownership and it goes through an assumption, we want to help them either way.
And in 6 months, they could do a cash out refi if they want to go get a new Corvette or something. Is that right, Tom?
100%. Yes. Let's do that.
What's another thing that people should be aware of? Are there different timelines involved with assumptions compared to regular loans?
Well, yeah. So we tell people to expect double the timeline. And in some cases, I'm hearing people tell you to expect triple the timeline. Essentially, normally it's a 30-day process for us, or lately it's a 30-day process, right? Where you're under contract on February 1st. You're closing at the end of February. February's a bad month to bring that up, right? 28 days.
28 days.
But normally, let's say March 1st, you're closing on March 31st. At that point, you're dealing with a really motivated mortgage lender. You're dealing with a brand new home loan, and you're dealing with a team that's really, really focused on service. Different setting when it's an assumption, right? It's not a brand new home loan. You're taking over somebody else's home loan that's already in place. And it may not be a team that's super excited to get you the keys to that new house really, really fast.
I like to point out the fact that when you're dealing with assumptions, and correct me if I'm wrong, Tom, you're dealing with employees who are just paid an hourly wage. They're there to put their time in and go home at the end of the day. So there's no sense of urgency to get that loan processed, get that loan through underwriting, and get it to closing. Is that a safe assumption to say, or are you even allowed to comment on stuff like that?
I love our servicing team. Let me say that right up front, right? Our servicing team is the best. I'm a huge fan of all of our servicing team members. But I think that's somewhat of a fair statement to where I'm very much aware of contract close dates and hitting those close dates. And it's very important to me and my team here. It is not as important to them.
So if someone's going to go under contract on a house with their assumption, you're saying do 60 to 90-day closings on them?
I'm saying 60. So we've been telling people 60, but I honestly think it should be a conversation with that servicing company. And we've got more under our belt in the last 4 to 6 months to where we're getting better and better at them. Our servicing team is getting better and better at them. So it might have been 90 days at the beginning, and now it's 60. And like I said, they're getting better and better. So I think you contact that listing side servicing company and ask them, hey, what's the average what's the average in assumptions taking you guys right now? Put that on the contract.
All right, perfect. That's great news. So if it's Gateway Servicing Department, do they fill out a full-blown loan app again, or is it some sort of different packet? What is it called? 1004 or 1041, or is it something different?
Yeah, the 1004 and the 1008 are essentially a loan application, just kind of older terms for the loan application. But yeah, you would fill out a loan application, 2 years of employment history, 2 years of residence history, name, social, date of birth, all this stuff to allow us to look at credit, allow us to determine some income and some assets.
Awesome, Tom. Now, are there some specific homes, like as real estate agents, to help our customers find opportunities like these? Are there specific loans that we could go into our software and look for? Like, I think I've heard USDA and FHA. Are those
Yes,
loans
sir.
that do it?
USDA, FHA, VA, the government programs are traditionally assumable. The conventional loans are traditionally not assumable. So if you can search, if you have a way to search, right, all the FHA loans in the last few years, maybe the last, March of 2020, right? Find out those are the ones usually with the low rates. And
Yeah,
absolutely.
as real estate agents, we have Core Logic. Do you guys use Core Logic on the mortgage side? Does it?
We do, but we use it for compliance mostly, but I bet you I could use it for sales.
Yeah. Yeah, we could go into Core Logic and we could literally put in the loan type and then the date range, and then we could put in the square footage for the customers that they're looking for. Boom, we've got that list. And if that's something that you could do for your agents, because I know you work with more than just my team and I, because you got to make money. That could be a value service that Gateway could add to its real estate agents.
Love it.
What do they need to know? Like, do they just take it over and that's it? Do they what is involved in the process? Do they got to bring extra money?
They usually have to bring extra money. So I'm going to walk you through kind of a little bit of the math on a simple one, right? So somebody bought a house in July of 2020 for $100,000. When they bought it, they put 10% down. We'll say 5%, right? So they put $5,000 down. They got a loan amount of 95 on an FHA loan. Fast forward to now, right? It's 3 years later, say 2.5 years later, they've paid some of that balance, right? So maybe now the balance is 90. The home is also
worth $150K.
Well, it's that, there we go, right? Appreciation, right? The home is also appreciated over the last couple of years. So let's not say 150. Let's say it's worth 125.
Okay.
So now we're working with 125 sales price and a $90,000 loan. There's a $35,000 difference, right? The buyer has to meet that gap, and we will not allow second mortgages or second liens to meet that gap.
So they just need to bring $35K to closing plus closing costs. Bada boom, bada bing. They got a 2.5% to 3% loan, depending on what the loan says.
No problem. Absolutely.
Man, that's cheaper than people were buying houses for 2-3 years ago when they were having to bring 40 to 100 grand over ask. And that's way cheaper than just bringing the difference.
And this will go straight to equity. Absolutely.
Yeah. And then in 6 months, and I'm not holding anything, everyone's circumstances changes. We're at the proof credit and all those disclosures and disclaimers, but within 6 months, they can do some cash out refi and get some of that back if they need it. Is that true, or am I just making that up?
No, that's true. There's a delayed financing rule that, technically you could take advantage of some of that within 6 months. It would just be harder to capture. If you wait 6 months, it frees up a lot of that equity.
And those are 80% loans. So if it's 125, they go up to 80% and then pull that difference back out and stick it in T-bills.
Correct. If T-bills is where it's at, yes.
That's what Alex Hermosi says. He knows everything. $100 million offers.
Go with the T-bills.
So what about VA loans? Is there a difference between a VA, an actual veteran assuming a VA loan compared to a civilian assuming a VA loan? Is there a difference in there, and what affects the veteran who's selling or letting the loan be assumed?
There is. That's a great question. Great topic. Great thing for us to discuss. But I'll tell you right now, my servicing team said VA is the most often, people are assuming VA loans the most often right now over the past 4 to 6 months that we've been kind of doing more assumptions than ever. So VA is the most often assumed. If a veteran is assuming a loan from another veteran, it frees up the entitlement of the first veteran, right? The seller. Now, if that seller is sorry, if the buyer is not a veteran, the seller's entitlement will stay with the property.
That portion of the entitlement, like if they have a $500,000 entitlement, but they're only losing $100,000, they still have a $400,000 entitlement. Those are numbers I straight made up.
Yeah, you did. So no, everybody gets a certain amount of entitlement, and it's much smaller than that. And when you buy a house of a $500,000 house, you're using you most likely use a large portion of your entitlement, and it's a formula that you have to go through with every veteran individually, with where they've used their entitlement in the past, where they're currently using their entitlement, what they plan to use for their entitlement. Yeah, it's a formula that you have to use. But essentially, if a non-veteran is assuming a loan from a veteran, that veteran needs to figure out his or her entitlement, and if they need it in the future, it's something they need to be aware of.
If they need it in the future, if they're just going to take that equity and toss it to a conventional loan, not use a VA loan, then at that time, it won't matter.
Correct.
But if they all of a sudden want to do VA, it'll
3 years
matter
down the
big
line,
time.
that entitlement's still stuck with that property.
Okay. Does it go down by the loan balance, or is it like GAAP, the generally accepted accounting procedures? Is the book value the always book value, or does it go down based on the loan value?
We'll go with that latter, right? The GAAP, the book value is the book value.
Wow. So at the time of the assumption, 100K is ate up. And then when that veteran wants to do something 5 years later, the 100K is the 100K, even if that loan is 50K.
Correct.
Whoa, that's something veterans need to keep in mind.
You use your entitlement when you buy the place. Yes.
Okay. So if a seller is getting ready to sell their home and they want to offer their loan as an assumption, as a mortgage lender, as a lending company, do you feel there's anything they need to be made aware of before they do that? Or once it's assumed it's off their hands, they're good to go?
The VA one, other than VA, you're saying if it's not a VA and it's something else, it's FHA, USDA, even some rare conventional ones are assumable. Yeah, that debt it will remove them of liability is the verbiage that we will use.
Okay, perfect. Wow, that's a big deal. So a seller can market their assumption as a positive, like, every loan's different, but let's say it's 3%, it's a 250K house. They have a 250K, they have 200 balance on it. They can offer that $200,000 balance at a 3% rate as a marketing avenue to attract more buyers that have the equity to cover the difference.
Yes. I have if I'm the seller, right, I got the product at 3%. Everybody else has the product at 6%. Market.
I'm going to buy your house.
Yeah.
I'm going to buy, even if I got to replace the countertops, I'm buying your house. 3% compared to 6% on 200K, that's 18,000 a year, right?
Man, I'd have to do that math. Yeah.
3%, 246. That's 6,000 a year. That's 6,000 a year. Never mind. So, wow, Tom. Well, so if the sellers get ready to sell their home, do they just reach out to the servicer to get the servicing application packet, or what? When do they need to do that?
I would think as an agent, you'd advise them to do it right away. So if I'm thinking about selling my house, I'm calling an agent, telling them, hey, Josh, I want to sell my house. Let's talk about it. My next call is to my servicer and saying, hey, is my loan assumable? And if they say, yes, your loan is assumable, then I say, okay, I'm going to market it as an assumable loan. What would the buyer need to help kind of get a jump start? And so they'll send you that assumption packet that you're talking about. And if I'm the seller, right, or the agent, I'm saying, hey, here's the packet. If you want to assume this loan, here's the first step.
Wow. And I know you can't speak for other banks, and you can't speak for every single loan. Full disclosure, we're talking in generalities. If a seller fell on some hard times, and let's say they took advantage of the blank deferment payments, we don't want to say the word before the deferment payments because we might get penalized or something. Does that affect a loan being assumable, or do they just need to pay off whatever those deferred payments are?
Yeah, usually that is only going to affect your payoff. So, whenever you close, that's when it's determined whether or not your loan is assumable. From my knowledge, I don't think your repayment ability affects the assumption of the loan, right? A loan is either assumable or it's not. So if you got into that forbearance or you got into that, didn't pay for 6 months, we got some relief. It should just impact the balance of your payoff, right? If you never made those 6 months payments, it's most of the time it's going to be tacked onto the payoff.
So theoretically, that would not stop someone from still offering an assumable loan, but they need to verify with the servicer just to make sure. And they definitely want to know what that payoff is on those particular payments on top of whatever the primary says online.
Yes, 100%. We've had that for sure.
And I want to pick your brain a little bit more. And if you don't know the answer, say, Josh, quit asking me questions I don't know. What if someone fell on hard times? They didn't do the deferred payments, but they fell on hard times and they're going to foreclosure. Can loans going to foreclosure still be assumed potentially?
I'd have to look that up, but I would imagine yes.
Wow.
I'd have to look that up.
Wow. So USDA, FHA, and VA are pretty much shoo-ins for assumability. The buyer has to have the difference to cover the spread, whatever the loan balance is, to the marketable sales price that a buyer and a seller agree to. They need to fill out the application. They need to plan for a little bit longer closing, but get that number from the servicer. What are we missing? What other things do we need to know about assumable loans? This is great info, Tom. This is huge.
Let me look at my notes really quickly. Man, I think we've covered it, Josh.
Man,
hey,
it's only
actually,
16 minutes.
Hey, one of the things you just asked me was whether or not somebody in foreclosure can be saved from an assumption. One of my notes says the loan must be current. So let me go. I'll do some digging on that one. But for right now, let's say that the loan has to be current to be assumed.
So then we might not know about the deferred payments too then.
Correct.
Okay, so the loan has to be current. I'm going to go with that since it's in your notes. And of course, I know you're going to verify and get back with us.
Yes.
But so they definitely need to check if their seller who took advantage of the deferred payments and if they're getting ready to go through the foreclosure process. Look, guys, life happens, man. It happens. There's been times in my life where I've ate, just ramen noodles and potatoes. I get it. Don't be upset if you're going through the foreclosure process. We can still get you a buyer and get you out of that in time if the numbers work for everybody. So don't let us saying your loans are not assumable not work out. People are still buying homes with 6%, 7% interest rates all day long because you either got to buy a home or you got to rent a home. And renting a home, guys, that's 100% interest. You don't want to give 100% interest to the landlord. You need to buy your own home and have some home ownership wealth. But I'm a real estate agent, so of course that's my job. That's what I do. Tom, tell me what's the best way for customers to get a hold of you if they have questions about refinancing, if they have questions about pre-qualifications. A lot of people. Can I ask you another question that doesn't have to do with assumptions, Tom?
Absolutely.
Okay, when it comes to people moving from out of state, they need to have from their lender, correct me if I'm wrong, I'm asking you because I get this question a lot as a real estate agent. They need, if they're moving from out of state and keeping that out of state job, the lender wants something from the HR department saying they're not going to get fired from moving. Is that right?
That's absolutely correct. And that, right, the last few years, it was more prevalent than ever the last few years. People, whatever, they work in California and they're working remotely, and they want to move to Oklahoma and they can still work remotely. Absolutely. But it's kind of shifted a bit where some places are making you come back to work. Or come into the office. I shouldn't say it like that, right? Making you come into an office. So if you are moving here from California, you're moving to Oklahoma. I'm in Oklahoma City. You're moving to Oklahoma City from California, and you've been working remotely for 2 or 3 years. We need some confirmation that they are going to allow you to continue working remotely. Absolutely. So sometimes it's just a simple letter from HR, right? We're going to allow Josh to move to Oklahoma and continue his hours and everything. Or most of the time it's a letter from HR.
And then And then people don't pay attention to this. And it's something that happens on the backside that we never ever talk about. But there's also called the gap check for loan purposes too. You might send out that request at the beginning of the process, and then you might send out that request again 2 days before closing. Is that right? That people need to be aware of?
100%. So we do, gap check threw me off, right? Gap check we use for title work. But we call that a verbal
Final
verification
underwriting.
Yes, for underwriting. Yes. We do what's called a verbal verification of employment. Every company has to do it within 10 days of closing. Sometimes it's within 5 days of closing to, some different loan programs, some different guidelines. But yes, so you can't
get fired.
You're going to get caught if you try and hide that, I guess I should say.
No, yeah, and we're not trying to be like get caught or hide it. We're just saying be upfront with this. Be upfront
100%. I want to know it all up front. Yeah, so
Yeah.
we can solve the problems if we know the problems.
If the company has a meeting after you fill out the loan application, after your 2 to 3 weeks throughout this process, buying a regular home, not just assumptions, and they're like, okay, guys, we're going to have you start coming in the office. Let us know so we can start working on options on the real estate side of things and on the lending side of things, right?
100%.
And when they're moving to Oklahoma from another state, Tom, if they've got what is it called? An offer, a work offer. It just needs to be in the same industry with a close to the same job title. They don't want to go from like basket weaving to kite making, right?
Correct. An offer letter is what you're talking about. And so for some loan programs, absolutely, we can use those offer letters, and we use projected income. So technically, if you were moving here and you were starting your job on March 1st, you could close on February 15th. With that projected income that we calculate for you.
Okay. And is there too long of a delay? Like if they want to take 2 weeks off, will that get them in trouble or?
It's usually 90 days. You have to start your job within 90 days of your closing. And sometimes we'll ask to show that you've got some reserves, right, to make that first couple mortgage payments. We definitely have you have to clear all contingencies on the job offer letter. So, lots of hospitals will make sure you pass a drug test and make sure you pass these tests or whatever. You have to get past those contingencies for us to use that projected income. But yeah, projected income is a great tool.
Man, that's awesome, Tom. I may have already said this during the video. What's the best number for people to reach out to you directly if they have some private questions they want to ask you?
Call me 405-751-3800. You can visit me online at gatewayokc.com.
Gatewayokc.com. Man, Tom, this has been super informative. Guys, tons of information Tom gave us today. Go back, rewind it, watch it again, or just call him and be like, give me the lowdown so we can talk about this, whether it's assumptions. If you're a real estate agent and you got assumption questions, Tom, they can call you too, right?
I want to be a resource. Absolutely. Call me, please.
All right, guys. If you're getting a home loan or refinance loan, are those the two loans that you do? Or are there any other loans I'm missing out? What about like student education loans? Does Gateway do that? Are you part of that?
Residential mortgage loans.
Residential mortgage loans. Okay. So no commercial divisions. You got a commercial.
We got a commercial division. I can get you to the commercial people for sure. We got a good commercial.
You're having an earthquake there in Edmond.
Yeah.
All right. Tom, thanks so much. Amazing as always. Is there a realtor event that you want to put out there to all our real estate buddies watching this today?
We've got an event Friday the 27th. We're teaching personal finance. Call me. I'll get an invitation out to you.
All right. And you just did a class over at the old Berkshire, right? Over at
McGraw.
What was that?
Yes,
the
sir.
Personal finance? Was it the same one?
That was personal finance. And then we had a CPA teaching taxes to real estate agents. So that was a really good class.
Oh, that's horrible. Just let them do it.
Well, I'll tell you, the one takeaway from that class was if you are a real estate agent, don't call your CPA in December and ask them what you should do for the remaining 2 weeks of the year. Call them today and formulate a plan for the next 12 months.
You should go get one of those EV vehicles and move to Wyoming, right?
If it weighs 8,000 pounds, let's spend a bunch of money on it.
Wyoming's outlining those. Did you see that?
Oh, I don't know. No,
they're outlining them. California's like, we're outlining gas vehicles. Wyoming's like, we're outlining EV vehicles. How about them apples?
Fun competition there.
Yeah, it is. All right, Tom. I won't get into politics anymore. I know that you're a very neutral person. I'm not. So, folks, thank you for everything. Our American patriot, gentlemen and gentlewoman. Yes, we're saying that. We will see you guys on the next video. Give Tom Rosser a call at 405-751-3800 for all your lending needs, and give my team and I a call for all your real estate needs. Contact information down below. We'll see you guys on the next video.
Thanks, Josh.
Yes, sir.